Hello my fellow investors, and welcome back to another stock analysis video. Today guys, we are going to be analyzing the company Realty Income Corporation. This real estate company guys, it is a lot of people's favorite, and I do have videos on this company already analyzed, but you know, I had a really bad mic. On top of that, the calculator guys just wasn't that good. It wasn't that developed. And even still now guys, this is still the second company I have analyzed that's a REIT using this new version. So hopefully I can be a lot better than that of the first one when analyzing it. But man, REITs are just very, very difficult to just analyze in general guys. So yeah, we're going to be doing this again for like the third time, but we'll just take it as like the brand new time that we're doing this. Now this was actually recommended by a lot of people actually. Elizabeth Shelbourne as well as Stefan all asking for this company. Now Elizabeth, you did ask for other ones. We're going to take a look at those later, but for now, let's actually take a look at Realty Income Corporation. And before we actually move on to anything, let's actually see guys exactly what kind of clients they actually have. Realty Income is a really, really good one guys. Take a look at this. They actually have clients like Walgreens, Dollar General, 7-Eleven, Dollar Tree, FedEx. We got Walmart and Sam's Club, AMC Theaters, hey, hashtag AMC, right? Red Lobster, Regal, Barbecue, BJ's. They have a lot of good big name clientele guys, even companies like Kroger, CVS. So, you know, the fact that they have a lot of these types of clientels pretty much is telling me that their leases might be fairly good and covered, right? I don't think Walmart will ever stop paying the rent, right? So yeah, that's just a couple of points when it comes to this company. Also guys, full disclosure, I do own Realty Income Corporation and a decent amount. In fact, here is my Realty Income slice when it comes to M1 Finance. You can see that, well, I do own a little bit of it at around 28.57 shares, and my average share price guys is $62.94. I am significantly up as of today, since it is at around $67.69, but it has fallen less than $70. So I figured now it's a good time to actually analyze this company to see if at around this price, is it still a good buy. So now with all of that said, let's finally get started with this analysis. We are going to start off guys with, of course, the dividend summary. This company guys, it is notorious for its dividend. Everybody that's a dividend investor pretty much has Realty Income in their portfolio, whether it be their Roth IRA or their dividend income portfolio like I do, right? Because they actually pay a really good dividend guys. Current yield of 4.39% ends up being 25 cents per share for an annual payout of $2.97. Now you're saying, well, you know, that's not a lot, right? 25 cents, that we haven't seen higher. Except guys, that their main thing is they pay their dividends monthly. You get it every 15th of the month. So that's actually fairly good. Now, when it comes to the payout ratio, you see this right here. It is at 275.2%. And you're probably saying that's a lot. That's really a lot. Except that when it comes to REITs, this payout ratio that you see right here is completely wrong. This is even worse off than that of normal companies, because real estates follow a completely different kind of play when it comes to their payout ratio. By law, REITs are 100% forced to give out minimum 90% of their funds from operations, FFO, in the forms of dividends. So normally you have a massive payout ratio, and this also ends up being that the dividend yield is a little bit higher as well. Now this all sounds good except for one thing, and that is that unfortunately, because they are forced to give out 90% of their funds from operations in the form of a dividend, well, this means that when it comes to taxes, you actually flip majority of the taxes. Normally you do have a tax advantage when it comes to normal companies, where the brackets are shifted by a huge margin up until the first $40,000. If you're filing single, you pay 0 in federal taxes. In REITs, it's not that way at all. You pay taxes like normal. So yeah, you do get more higher dividends, but you also pay higher taxes as well. Now when it comes to the 5-year CAGR guys, it's also not too bad at 3.89%. What is really good though is this dividend growth of 25 consecutive years. Guys, this means that within the past 25 years, they have consistently grown this dividend. Also, something interesting about Realty Income is that pretty much every quarter they increase it by like a penny, which is hilarious, but it does add up over time. Now, ex-dividend date actually passed as of August 31st, and as I said, their payout day is every single 15th of every single month. Now you're probably saying, well, I missed it. Yeah, guys, but the ex-dividend date is actually coming up again on September 30th. So if you guys could not get in before 8/31, then you can still get in by September 30th. So you still have time for that. So now let's come over here, guys, to the REIT evaluation calculator. Again, you guys can find all of these calculators, discounted free cash flow, book value, and the REIT one, all in the video, which is linked in this description. There's that video then has a link to all the spreadsheets that you guys can have. It's available for free. More on that later. But nonetheless, guys, we got the ticker symbol of O, market cap of almost $42 billion with a current share price of $67.69. Current FFO, guys, is around $2 billion and AFFO is around $1.5 billion. Essentially, take this as the cash flow, and then the AFFO, it is the cash flow minus the capital expenditures. That's essentially what you want to take a look at. This is a company's essentially their cash flow, and this is the best metric to see whether or not the company is doing good when it comes to their income that they're making, or whether they're doing rather bad. Now we're going to take a look at the charts in just one second, but these are the current ones. Looking at the annual dividends per share, guys, we got $2.97 annually, as we saw. And based off of the amount of shares outstanding, they pay out almost $2 billion. Now, if we actually take a look at these payout ratios in regards to the FFO and the AFFO, we could see that they're at 98.16 and 123.2% respectively. And again, you're probably saying that's a lot, except that this is actually in line with what REITs should be at. They are forced to pay out minimum 90% of all of their funds from operations and AFFO in the forms of dividends, so this is actually looking fairly decent. So now let us do some analysis when it comes to their fundamentals, starting of course with the net income. We got 5 years ago, guys, of $318.8 million to today of $561.6 million. That is an increase, guys, of 76%. Fairly good. Now let's actually analyze this graph a little bit further. We can see that from 5 to 3 years ago, nice consistent increase. 2 years ago happened, COVID happened, right? Perfectly understandable as to why we saw this dip. And then 1 year ago, we saw another dip, probably because we still had the residual effects from COVID happening, right? And there were still a couple lockdowns on top of that. But then as of today, guys, look at this. Massive jump to $561.6 million. Now, in my personal opinion, that is a big jump from 3 to today. So I can't give it like a perfect score, but I would say like around like an 80% is good enough. Now taking a look at, guys, the FFO, the funds from operations. Again, this is essentially the company's cash flow. And looking at this graph, we can pretty much just see that it is actually amazing, right? 5 years ago, it was $772.7 million to today, guys, of almost $2 billion, just as we saw at the beginning of this calculator, right? This is a change, guys, of 142% with an average FFO of $1.2 billion. Guys, this graph actually looks really solid. It is staircasing year over year. And on top of that, even during COVID, they still did fairly good. Now, my one issue is this massive jump from 1 year ago to today of $1.24 billion to $1.86, essentially $2 billion, right? That I don't necessarily like that, but it is still really solid staircasing from 5 to 1 year ago. For that reason, I'm going to give this, guys, a 90%. Now let's take a look at, guys, the AFFO. This is adjusting for the capital expenditures. And this graph actually looks really good. Now you're probably seeing this and you're like, the today is missing. I don't know why, but it doesn't have it. Seeking Alpha doesn't have any current AFFO. I don't know if this is the case for all of them, but yeah, Seeking Alpha doesn't have AFFO. So I'm essentially omitting it from the graph. Just, you know, pretty much ignore it. I'm pretty sure that once the year ends and we get the CapEx, then it'll essentially fill in. But yeah, nonetheless, guys, we got 5 years ago of $838.6 million to 1 year ago, guys. Look at this, $1.5 billion. Increase of 78% with an average of almost $1.1 billion. Once again, this is an amazing looking graph, year over year, consistently increasing. We do see a little bit of an abnormal jump right here from 2 to 1 year ago, but it's not that bad, honestly. And it is staircasing every single year after that. For that reason, guys, I'm going to give this like a 97%. Now let's take a look at the assets minus the liabilities. Hopefully they have a lot more assets than they do liabilities, because if they don't, then this could be a big problem. Now, as of today, guys, they're at $26.4 billion, which is massive. And if you take a look at this graph, not only have they been increasing year over year, but we see a massive jump from 2 years ago to 1 year ago, more than doubling it from $11 billion to $25 billion. So yeah, that was a massive jump. I don't think that this is necessarily good, but as you can see, even today, they are still keeping this up to around the $26.4 billion mark. So it's fairly good. Now, overall, guys, I'm actually going to give this not a perfect score, but it's still going to be pretty high. If you take a look at the average assets, we get around $26 billion. Average liabilities is around $14.6 billion. And doing this difference, we get $11.5 billion. I'm going to give this, guys, essentially like a 75%, mainly because I do not like this massive jump right here from the 2 to 1 year ago. Now let's take a look at the shares outstanding. This metric, guys, in normal companies, you want this thing to be coming down. However, from the first company that I analyzed using this calculator, and now this one, we can see that in both of them, their shares outstanding is going up. I don't necessarily know if this is, again, a common thing when it comes to REITs. If anybody knows, please tell me in the comment section below. Again, I've only ever analyzed 2 REITs right now, and I don't know if this is a thing. From what it looks like, it seems to be a thing. But nonetheless, assuming that it is based on the same premise as normal companies, well, this is still really bad, because a company that issues shares, it is diluting you as the investor. You don't want that, right? So unfortunately, we do have an increase here when it comes to realty income. 5 years ago of 284.2. all the way up to today of 617.6. That is an increase of 117%. We do see a massive jump 2 years ago to 1 year ago, probably COVID related, but it is still a massive jump. Guys, I'm gonna have to give this a really low score, unfortunately, of around a 20%. They are consistently increasing shares year over year. Again, I don't know if this is a thing when it comes to REITs. I'm inclining to say yes. And if that's the case, then maybe down the line when I reanalyze this one, which I will eventually, I will just change this value to a lot higher, just because it is a common thing amongst all REITs. But as it stands, I'm going to take it as a normal company, and well, increasing year over year, and we see a massive jump over here. So it is what it is. I'm going to go with 20%. And now lastly, when it comes to total debt, I mainly just want to see this to see how the company's actually doing when it comes to their debts, just to see if there's any anomalies. And as it stands, guys, this actually looks fairly similar to that of the shares outstanding, where 2 years ago to 1 year ago, it was a massive jump. And as you can see, their debt has increased from the 5 years ago of around $6 billion to $16.5 billion, increase of 169%. I'm going to give this, guys, the same thing as the shares outstanding at around a 20%. So now let us do a quick overview on all of their fundamentals. We got net income, guys, of 80%. FFO, 90%, really good FFO. AFFO, 97%. Assets minus liabilities, 75%. Shares outstanding, guys, 20%. And total debt, 20%. For an overall grade of 74%. I have the total debt at a weight of around 5%. I don't really think it's that important. That falters into this kind of assessment. That's why I have it that low. So overall grade, guys, of 74%. It passes pretty much everything that I like. Again, the shares outstanding might be off. It may not be 20%, it may be a lot higher depending on what the normal trend for REITs is and their shares outstanding. But for now, I'm putting it at 20%, and this comes out to be a grade of 74%. It is fairly good at the current moment when it comes to their fundamentals. But now let us actually see the valuation for this company. At the current share price of $67.69, is this a good price to buy it at? We still don't know. Sure, their fundamentals are saying that based off of the past, they're pretty solid. But is $67, essentially $68, a good price to buy? Well, there's two ways that we could do this, guys. We could take a look at the net asset value and the price divided by FFO and AFFO. Starting off, guys, with the net asset value, is pretty much just taking all of their assets and liabilities, or essentially the most current one, and then dividing that by the total common shares outstanding to give us the asset value, the net asset value of the company. And as you can see, it is telling me that it should be worth at around $42.75, significantly lower than that of the current share price. However, there is another thing that we could do, and that is a ratio of price divided by FFO. This is essentially, guys, the company's PE ratio. And if you guys know PE ratio, it is normally price divided by earnings, and it could give us an inclination as to what the company price should be. Is it overpriced or underpriced? We can do the same thing when it comes to this, doing the price divided by the FFO to get a ratio of 22.37%. Now, this doesn't really tell us anything, right? However, what I also did is I took the average FFO and then took the price divided by that average FFO to get this P divided by FFO ratio of 36.00. So within the past 5 years of funds from operations, the ratio has been around 36. And if the current one is saying that it is 22.37, it is significantly lower, meaning that the current price of $67.69 might be fairly decent. Now, something that is way more accurate than this, it is essentially the same thing, but now using AFFO. Remember, AFFO takes into account capital expenditures. And if we do the same thing, price divided by AFFO, we get a ratio of 28.08. And then if we do the price divided by the average AFFO, we get 38.18. Again, telling us that at the current share price, it might be fairly good to buy it. So now, as it stands, when it comes to this, we do see that, well, according to the net asset, we may want to wait, but the ratios is telling us that it may actually not be too bad. This really just depends up to you. I personally bought this company at around like the $62 mark, as I showed you at the beginning of the video. So, you know, I'm not necessarily following this net asset value. I'm more following these ratios over here. It really just depends up to you. Even for a company like this, guys, and a REIT company that doesn't necessarily have any assumptions, I still suggest everybody to have these calculators. As I said, please have them. This is not financial advice. Every investment is the present value of all future cash flow. So if you want to analyze REITs, please have this one, discounted free cash flow for normal companies, and then book value for essentially banks and insurances. And on top of that, guys, I also have a dividend tracking sheet where if you want a company like this that pays out a dividend monthly, I mean, you can see it right here. I have it right there. You guys can use it to essentially track how much you have gains, losses, dividends monthly, you know, quarterly, etc., etc., etc. So I'm giving this out all for free, guys. All I'm asking for in return is just help me grow my channel. Like, subscribe, comment. Really does help it with the algorithm on YouTube. As of I'm recording this, guys, we're 10 away from 1,000. Please, 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 if you like this kind of content, if you like me taking on your guys' recommendations and so on, all I'm asking for in return, guys, is just help me grow my channel. Please subscribe, please like, it really does help. Really all I'm asking for. I am very grateful for every single one of you that have subscribed so far and that will subscribe in the future. At 1,000, I do plan on making a very special video. So please, if you do like this kind of content, help me out. All I'm asking for, it's free. Just hit that like, subscribe, and if you want to tell me something in the comment section, I'm usually pretty active when it comes to that. I will answer you guys, so thank you so much. I really do appreciate it. Now let's actually take a look at this company, guys, in the form of a dividend, because this company is known for its dividend. So let's say that you make the average US income $68,703, bringing this to the monthly, the yada yada yada, what I say every single time. It is $5,725, and now at the current annual dividends per share at around $2.97, guys, this would buy you 84.58 shares, which would end up being, guys, $251.20 in annual dividends, quarterly dividends of $62.80, and a monthly of almost $21. And remember, this company does pay monthly, so you would get in your portfolio pretty much $21 every single month when you put in this $5,725. And again, in accordance to these ratios, it does seem to be like a pretty good buy right now. All in all, Realty Income. I like this company. I own this company. I'm not so sure if I would keep buying it at around $67. My average price is $62. I'll probably wait till it falls to like $63 or something like that. But if not, honestly, I think this company is pretty solid overall, even at $67. That's just my personal opinion. Of course, remember, don't just buy it for a dividend, because you still want to analyze the company's fundamentals. And on top of that, remember, REITs, there are no tax incentives, so keep that in mind. that pretty much does it for this video. Like if you like, comment, subscribe. Really does help out with the algorithm on YouTube. You guys can follow me on my YouTube sites. Link in the description below. So with that said, peace out, and I will see you all in the next stock analysis video.